2026, we're about halfway through or coming up on it. It feels a little like a pivot year. There's a lot of things taking place geopolitically. Traditional markets feel a little shaky. I mean, there have been days where we've seen 1,000 point gains in the Dow Jones Industrial Average, multiple days that are just don't feel that common. You just never know what's going to happen. So accredited investors, they need strategies that deliver consistency, consistent income, and downside protection. I'm breaking down 4 different ways today. So number one, private lending and real estate debt. This is bread and butter. It's naturally what we do here. It's just private lending, going out, lending money to folks who are going to go typically remodel a property or update a property so they can put a tenant in it and then keep it for cash flow. It's predictable monthly cash flow. You're just becoming a bank, really, lending money, and it just keeps cycling. All collateral backed by real property. Bread and butter for us. Number two, though, preferred equity. Preferred equity has higher yield. It's higher yield than pure debt play, and it's a prioritized return structure. So in a capital structure standpoint, you've got your debt, right? Your senior first lender, and then you've got preferred equity and then common equity. So they take on more risk than the senior lender, and ultimately they're compensated more by having a higher yield. Number three, real assets and infrastructure. So I'm talking about things like data centers, cell phone towers, storage, solar, that is, long-term leases. These are inflation hedged in many cases. Oftentimes somebody's signing up for 15, 20, 25, 30-year primary lease terms and backed by some of the nation's largest companies that are out there, all names you would know. So they may not have typically as high a rate of return as some of the other ones I've mentioned, but they are backed by very prominent companies. Number four, private credit and structured notes. Now, these are premium yields with covenants. Private credit is taking a lot of flack in the general press today because there's a lot of money that has gone out, certainly in the AI side and in the data side of things. And some haven't performed that great. So you really got to know what you're getting into on the private credit side. A lot of those things end up for an average investor, end up in funds. So they get diluted. You really got to know what is going on inside that fund on the private credit side. So in 2026, at the end of the day, predictable income, it beats speculation. And if you want to learn more about how we help create predictable income for investors, drop the link below so you can do just that.